These clients lost $2 million in less than 6 months and went from being pretty much financially free to stuck back on the hamster wheel. Their story can teach you a bunch of lessons, even if you don't have $2 million in investments today. So this couple in their late 30s, they had been pretty sensible with their money. They weren't big spenders. They were quite good at their savings. They bought their own home. They made good progress paying that down. And they'd also built up a bunch of savings and investments. On top of that, they had employer shares. One of them worked for a tech company. That tech company had done really well, and they built up a really significant holding in that company. The reason that they ended up reaching out to us was because as the value of those shares built, they started getting increasingly nervous because they didn't have any plan or strategy in place. They knew that there were implications. They knew that they'd been making good money, but they didn't really know what the best approach was going to be. So they reached out for some help. Now we started getting into the planning, and we realized that based on the value of the shares that they had right now, that they were pretty much going to be financially free. If they were able to cash out all of the shares and put that money into investments, that those investments would cover all of their living expenses and mean that they never really had to work again if they didn't want to. Now, these guys didn't want to retire, but they did like the idea of having the financial freedom and the flexibility to be able to do whatever they wanted. So through that planning process, these guys decided to sell down the shares and invest into a more diversified income-focused share portfolio that they could reinvest the income with to grow it further while they didn't want to work, but know that they had that option there in their back pocket. The challenging thing was, though, in terms of executing on this, is because the guy was quite senior in this company, it meant that he had these blackout periods where he wasn't able to trade the shares. So we agreed to trade the shares at the next, when the blackout period finished, and then he was going to cash out and ride off into the sunset, essentially. Now, the blackout period corresponded with an earnings announcement, as they typically do, and basically as soon as the earnings announcement is made, there's typically an impact to the share price, and then they're able to sell down those shares at that point in time. Unfortunately for these guys, that the earnings call was way below expectations, and the share price went down by about 35% immediately before the blackout window opened, and so his wealth went from $2 million to a bit under $1.5 million, basically overnight. Now, it's difficult to cop a loss like that, and no one likes seeing it, but for these guys, that they sort of agonized and wanted to know, what was the best move. Given that they'd just seen basically a $500,000 plus reduction in their wealth position, they were really reluctant to actually sell down on the shares. We spent a fair bit of time talking about it and noted that no one's got a crystal ball, and share prices can always go higher or they can go lower. Whether they do or not really depends on the performance of the company. Now, these guys decided to take a punt and hold on a little bit longer, hoping that the share price would turn around. Unfortunately for them, it didn't, and in fact, it kept sliding down. It still hasn't recovered to its previous highs. And on top of the share price declining even further, with these employer shares, because they become available to them when the share price was higher, it actually created a tax liability that needed to be funded. So in the end, they were forced to sell down a bunch of the shares to cover the tax bill, and they pretty much walked away with a really small amount of money relative to the $2 million that they thought they were going to have at the start. Now, the lesson with this is that if you've got shares with an employer or any shares that are doing really well, you want to have a really clear strategy around that. Now, it's natural with the psychology and the thinking around our money that when you see shares, particularly when they're performing well, you feel like it's going to keep continuing that way. And of course you want to make that extra money, but you don't always think about the risk that comes along with that and how much of a negative impact it can have on your financial plans. For these guys, they learned this lesson the hard way, but for anyone else, you really shouldn't be thinking about this stuff at the last minute. You want to have a clear strategy before you get into that position, because I know for these guys, if they would have done that, they would have decided to sell sooner. They would have been taking money off the table over the couple of years before that, so that the negative impact wasn't going to be so big. Good performing investments are clearly a huge opportunity and something that is awesome to have as part of your strategy, but it is a double-edged sword. Managing that risk is all important.